Have you ever noticed how some traders manage to stay consistently profitable, while others keep struggling? Even though they're using the same tool like trend lines, the real difference comes down to how those trend lines are actually used. Hey traders, welcome back to the channel. I'm Tory Trades, and I've been active in the markets for over 10 years. My goal here is simple: share practical insights that can help you level up your trading skills. In this in-depth masterclass, we're going to break everything down step by step. You'll learn what trend lines really are, why they matter so much, and how to draw them the right way. Then we'll move into strategy, how to actually use them to make smarter decisions in the market. I'll also walk you through real chart examples using live-style data, plus share some advanced tips that most traders overlook. Now, if you're new to this concept, trend lines are one of the core building blocks of technical analysis. They help visualize both the direction and the momentum of price movement. More importantly, they allow traders to spot trends early and anticipate potential reversals. So, what kind of trend lines are there? There are two main types. First, we have the upward trend line. This is formed by connecting higher lows, showing that price is generally moving upward. This reflects bullish behavior. On the other hand, we have downward trend lines. These connect lower highs and indicate a downward movement, which signals bearish conditions. So whether you call them bullish, bearish, upward, or downward, it all comes down to how price is behaving. Now, let's talk about how to actually draw them correctly. This is where things get interesting. Before you even start drawing, you need to choose a time frame. This depends on your trading style. Whether you're a day trader, swing trader, or long-term investor, your time frame will influence how your trend lines look and behave. Next comes the tools. What are we using to draw these lines? For this example, I'll be using a platform like TradingView, along with its built-in drawing tools to map out trend lines clearly. Alright, now let's jump into the charts. We're opening up TradingView, and right now you're looking at a clean chart. I'm going to walk you through exactly how I analyze charts, select time frames, and identify the key highs and lows for drawing trend lines. One important rule I always follow: whenever I analyze a new market, I start with a top-down approach. That means I begin from the highest time frame possible. Right now, we're looking at the YM, which is the Micro E-mini Dow Jones Futures Contract. This is basically a smaller version of the Dow Jones Index that traders can access through the futures market. So let's switch to the monthly chart. The reason I start with a higher time frame is simple. I want a complete big picture view. From the far left of the chart all the way to the current price on the right, I want to understand the overall direction of the market. At the same time, I begin marking up my chart. Now, here's something interesting. While most people use the standard trend line tool on TradingView, I actually prefer not to use it. Why? Because the default tool only connects point A to point B and stops there. Instead, I want a line that extends continuously in one direction. So I use the Ray tool, which allows the line to project forward indefinitely. Now let's draw our first upward trend line. To do this, we start by identifying the lowest visible point on the chart. This becomes point A. Next, we look for a higher low that hasn't been broken by price. That becomes point B. Here's the key idea. The line should act as a support guide, almost like it's holding price from falling further. Now, you might be tempted to use a previous higher low, but if price is already broken through that level, it's no longer valid for our trend line. Instead, I prefer to anchor point B at the most recent clean touch point, where price clearly respected that level. Right here around October 2nd, 2023. This is where everything starts to come together. Now we've officially created our first upward trend line. We got point A, point B, and now point C, giving us 3 clear touch points. Even though the Ray tool only allows 2 anchor points, those additional touches help validate the strength of the trend line. But this is just the beginning. So far, we've only marked one trend line on the monthly chart. To build a complete picture, we need to continue our top-down analysis by moving into lower time frames. Let's drop down from the monthly to the weekly. At this stage, the goal is refinement. I'm adjusting my existing lines to better align with price action. As you can see, the line was slightly off, so I shifted to match a more accurate low. What I'm doing here is trying to capture as much of the price movement as possible. As I continue connecting these levels, something interesting happens. the chart begins to form what looks like a fan of trend lines. Each new line becomes steeper, and here's the key concept. Your previous point B now becomes your new point A. Let me show you. Now that we're on the weekly chart, I go back to the ray tool. My new point A is the last touch point from before. From there, I look for the next most recent low. At first glance, it might seem like this level here works, but there's actually a more recent low further ahead. So I adjust point B to that level. And just like that, we now have another clean upward trend line with 3 touch points, similar to what we saw on the monthly chart, but now more refined. At this point, we're doing a much better job of tracking price movement. We're not just drawing random lines. We're actually following the direction of the market in a structured way. Now let's keep moving down. From weekly, we go to the daily time frame. Sometimes when you switch time frames, there may not be anything new to draw, and that's completely normal. In those cases, you simply continue moving lower. So here we are on the daily. Same process applies. Previous point B becomes a new point A, and we look for the next valid low that price hasn't broken through. Now let's move to the 4-hour chart. At this stage, something changes. We've already pushed our upward trend lines as far as they can reasonably go. There's no steeper line left to draw in that direction. But now, we finally have an opportunity to draw our first downward trend line. The concept is the same, just flipped. Instead of looking for lows, we now look for highs. So we identify the highest visible point on the chart. That becomes point A. Then we find a lower high that hasn't been broken by price. That becomes point B. That gives us our first downward trend line. Now, even within the 4-hour chart, I can see an opportunity to draw an even steeper line. So again, I repeat the process. Previous point B becomes a new point A, and I connect it to a more recent lower high. Now we're building a complete structure, both upward and downward trend lines working together. At this stage, we've reached the limit of what we can do on the 4-hour chart. So now we move down to the 1-hour time frame. And this is where I personally stop. A lot of traders ask, how do you know which time frame to stay on? The answer is simple. You stick to the time frame you've chosen to trade. I don't jump back and forth between time frames looking for faster entries. Once I commit to a time frame, all my trade decisions happen there. However, when I'm marking up charts for the first time, I always go through this full top-down process. Now that we're on the 1-hour chart, I can still make a few adjustments. I can even identify a slightly steeper trend line. So again, previous point B becomes new point A, and I connect it to a fresh lower high. In fact, I can refine it one more time for even better precision. Now, if price continues moving down from here, this line could form a clean 3-touch trend line as well. At this point, our analysis is complete. We've gone from monthly, weekly, daily, 4-hour, all the way down to the 1-hour chart, which is where we'll execute trades. So now you've seen how to properly mark up charts and draw accurate trend lines. Next step, how do we actually use them in a trading strategy? There are 2 primary ways to trade using trend lines. The first is the bounce strategy. The second is the breakout strategy. And sometimes a combination of both. Let's start with the bounce concept. When price approaches a trend line, we anticipate that it may respect that level and bounce off it, indicating a continuation of the trend. For example, looking at the current price of the YM, we could consider entering a short position, expecting price to reject the trend line and continue moving downward. So this is where a sell trade would be placed. Now the question becomes, how do we manage risk? Risk management is everything. You need to understand your account size and decide what percentage you're willing to risk per trade. For beginners, a solid rule is risking around 1% to 2% of your total capital. So if you had an account size of $128,000, that would mean risking somewhere between $1,000 and $2,500 on a trade. But here's the important part. You don't always need to risk the full amount. So where should your stop loss be placed? It's actually very straightforward. Your stop loss should always go on the opposite side of the trend line. If price fails to respect the trend line and instead breaks through it, that's your clear signal to exit the trade. In this example, the total risk might only be around $50. So if price reaches that invalidation level, We simply close a position and accept a small, controlled loss. But what happens if the trade starts moving in our favor? Here's where this approach becomes really powerful. There's no strict requirement for a fixed take profit. Of course, you can still set one if you prefer locking in quick gains or building consistency. A common approach is to target key support or resistance zones, areas where price has reacted multiple times in the past. For example, placing your take profit near a previous support level makes sense, since price often revisits those zones and react again. Now, in this scenario, we could easily set a take profit and capture around $90. But personally, I prefer to let the trend develop fully. Instead of exiting early, I allow price to continue moving as long as it respects the trend structure. So imagine price continues downward, pulls back slightly, then resumes its move lower while following that downward trend line. As that happens, we begin adjusting our stop loss. Initially, it was sitting at a small loss, but now we start trailing it into profit. We gradually move the stop along with the trend line as price continues in our favor. And the moment price breaks that trend line, that's our signal to exit and secure gains. So let's say price eventually breaks. By that point, we could have trailed our stop all the way down to around 43,358, locking in a profit of roughly $129. Think of it as manually securing profit step by step as price progresses. You're not guessing, you're reacting to structure. And if the trade doesn't work out, you'll know quickly, especially with a bounce setup, since your stop was already placed on the other side of the trend line, around 43,719. Now let's go over another scenario, the breakout strategy. We'll close this example and walk through a different setup. Since we don't have a live breakout here, let's visualize one. Let's say price moves down and breaks through an upward trend line. With the breakout approach, we enter when structure breaks, not when price bounces. This means we're anticipating a potential trend reversal. Now keep in mind, this upward trend line was drawn from a higher time frame, so it carries more significance. A break here suggests that the overall trend may be shifting. So instead of looking for buys, we start considering short positions. Let's say we enter short around 43,047 after the break. Now, risk management remains the same. The only difference is the reason behind the entry. Instead of expecting continuation, we're now trading a reversal. So we enter short and place our stop above the structure, somewhere near 43,592. If price moves up and invalidates the setup, we exit with a small loss, again, roughly around $50. But if price continues downward along the trend line, we stay in the trade. As price moves in our favor, we trail our stop and lock in profits gradually. If price breaks the structure, we exit. If not, we let the trade continue. Now, regarding position size, earlier we used a single contract as an example. But with an account size of $128,000, you could risk between $1,000 and $2,500 per trade using the 1 to 2% rule. That said, for beginners, starting small, like using micro contracts, is a much better approach. Now, the exit rules remain exactly the same as before. As long as price respects the trend line, we stay in the trade and continue managing it. If price breaks the structure, we exit, either in profit or with a small loss. Now let's look at a real example from a live trade. In this case, we had a clear upward trend line with 3 touch points. Once price broke below it, that became my signal to enter a short position. What kept me in the trade was structure. My stop loss was placed on the opposite side of the downward trend line, and I was willing to risk around $8,900 on that setup. Now, how long do you hold a trade like this? That depends on your objective. If you prefer shorter trades, you can target key support or resistance areas. In this example, price approached a strong support zone, one where it had reacted multiple times before. That made it a logical place to exit. So I closed the trade around a 72.26 level on crude oil, securing a profit of $27,600. That resulted in a 3.11 our return. And yes, this was a real trade using the breakout strategy. Now, before we wrap up, here are a few advanced tips. First, trend lines are not permanent. As price evolves, you'll eventually break through your lines, so you need to adjust them regularly. This means redefining your points, creating steeper lines, or shifting them to new highs and lows, while making sure they remain valid. Second, always use multiple time frames. That top-down approach gives you a much clearer understanding of overall market direction. Higher time frames provide the bigger picture, while lower time frames help fine-tune your entries. And finally, use support and resistance levels for take profits. This is especially useful if you don't want to hold trades for extended periods, or if your goal is to build consistency through smaller wins. So that's it. A complete breakdown of how to analyze charts from top to bottom, draw accurate trend lines, and apply them in a structured trading strategy. Now it's your turn. Start practicing, mark up your charts, and begin applying these concepts. And if you want to go deeper, check out the link in the description to join the community and learn alongside others using the same approach. Thanks for watching. I'll see you in the next one.